Did you know that a former NFL tight end, Rob Gronkowski, who is already a multimillionaire, still lives on a budget? Gronk still hasn't touched a dime of his NFL contract money or bonuses and is strictly living on sponsorship and marketing money. He wrote on Instagram a while ago that he still wears the same jeans from high school and he doesn't buy any expensive jewelry or expensive cars. But on the other hand, a celebrity like Lady Gaga actually went bankrupt and she was $3 million in debt after doing the tour. She told the Financial Times that she had no idea she ran out of money after winning Grammys and having 5 #1 singles. She's obviously doing much better now after she took control of her own finances. So why am I telling you all this? Because when I go into the top 10 financial mistakes people made in 2023, it's not just math, but it's also how we all behave with our money. As a financial coach and a financial planner, I can tell you all day that spending $1,500 a month on restaurants while you're in $30,000 in credit card debt is not a good idea. But if you do it anyway, then that's how you behave with your money. You could blame it on inflation, but it is still you who makes these financial decisions. Why do you think 70% of lottery winners go bankrupt within a few years? Is it always a money issue or a behavior issue?
You won the lottery.
The first financial mistake a lot of people made in 2023 was using their home equity like a piggy bank during a high interest rate economy. It's not a secret that mortgage rates are at a 20-year high at 8%, 9%, or even 10% if you cash out refinance your home. I refinanced my house in 2020, but it made sense to do it at the time because the interest rates were at 2% or 2.5%. And I never cashed out of my home because I wanted to keep the equity in there, personal preference, right? But people who cashed out and refinanced their homes in 2023 increased their mortgage payments. So for example, someone with a mortgage balance of $200,000 with a 4% interest rate, and I'm going to assume that it's a $1,200 P&I payments with the original loan at $250,000. Then you decide to cash out refi, $100,000 in equity. The new mortgage balance is $300,000 with a 9% interest rate with a new payment of $2,400 a month. So not only did your payment double, but your interest rates also increased from 4% to 9%. Now I'm using the most conservative numbers here. Cashing out some equity in your home to pay off your high interest debt could make sense. However, it doesn't make sense if the new mortgage payment exceeds 25% of your gross income. It also doesn't make sense to cash out refi when interest rates are higher than the average stock market returns for the past 20 years. Now, people with HELOC are also getting hit hard with rising interest rates in 2023. The average credit line size a HELOC borrower gets is around $150,000, but the average utilization is around 40% of the line amount. And keep in mind that HELOC comes with variable interest rates like a credit card. The other risk is if your home value depreciates going into 2024, the loan to value ratios will go up even higher. HELOC lenders typically allow you to have a combined LTV, that would be the loan to value ratio, of up to 80 or 90%. Most of them only allow up to 80%. Let me use the example I used earlier. If you have a mortgage balance of $200,000 and your home is worth $500,000, then you have a combined LTV or CLTV of 40% because $200,000 divided by $500,000 is 0.4. If your lender allows up to 80% of CLTV, then you can have a maximum of $400,000, which is 80% of your total home value. So $400,000 minus $200,000 in loan would be $200,000. So you could get a HELOC up to $200,000. But because the interest rates keep going up, those interest-only payments also keep going up. The other risk is that if your home value goes down, then your lender could enforce what's called a HELOC reduction so that you can maintain the 80% loan-to-value ratio. If you can't make the repayments because of the high interest rates, you could potentially lose your home to the lender. And I've told many people this throughout 2023 during the free consultation calls. Please don't take out any HELOC or cash out refinance in 2023. It just doesn't financially make sense. If you're looking to pay down your debt, this is not the way to do it. It's going to become a debt consolidation using your home equity that only solves a temporary problem. And I encourage you to schedule a free consultation with me by visiting financialconsultation.com/coaching so that we can find other ways to pay down your debt or do your home improvement. Mistake number 2 that many people made in 2023 is co-signing a loan for a friend or a family member. You'd be surprised to know that I did this back in 2009 when I co-signed a car loan for a friend of mine. He was a roommate. And that really bit me in the butt down the line. He asked me if I could co-sign for a car loan because his credit scores were like in the 600s. Not knowing what I know now, he missed some car payments and eventually got his car repossessed by the lender. And my credit scores took a huge hit. And I remember how the lender called me almost every single day because I signed off on the loan. So I was equally responsible for the car payments. What really sucked was that I couldn't get a hold of the guy who I co-signed the loan with. And I'm pretty sure he deleted me from Facebook and Instagram too. I haven't talked to him in years. So my credit scores went down from like 700s to about 600s in 2009. This is after the Great Recession, and until I made some disputes with my credit scores. And it was a long process because I had to get in contact with the lender and everything. And luckily, the total car loan was only about $5,000 remaining after all the late fees and penalties. And he actually made some car payments too. But the original car loan was about $8,000. Like, it was a really cheap used car back then. And I negotiated with the lender and paid the loan amount in full after taking out a personal loan, which also hurt. And my credit scores also went back into the green when I disputed the negative report by showing proof of payment. So I ended up paying a car loan for a car that I didn't even physically own. And guys, do not co-sign a loan for your family and friends. The only person you should co-sign a loan with is your spouse. And that's it. Not your boyfriend, not your girlfriend, and not your childhood friend. If my story isn't enough to convince you to stay out of this, then I don't know what else to tell you. And mistake number 3 is not budgeting for annual expenses. And I have an annual expenses spreadsheet that you can download for absolutely free by visiting firestarter.com/resources. You don't even need a credit card to sign up for my free membership to get these resources. I have a completely separate high-yield savings account just for my annual expenses. I still use this spreadsheet today to budget for them. And if you look at the left-hand side here, that's where you can adjust your contribution schedule based on your paycheck schedule. And if you get paid bi-weekly, then just deposit it every 2 weeks. If you get paid on the 1st and the 15th, then make the deposit twice a month. And I have my vehicle maintenance that's due in October of every year. Based on last year, it was $250. So I want to make sure that I have a minimum starting in January, have $12 contributed every 2 weeks into my annual expenses fund, so that by the time October hits, I will have more than $250 to pay for my vehicle maintenance. So let's say I have another expense in December when I want to do some holiday shopping for, let's say, $500. Why not? Then I want to make sure I add another $20 here at the beginning of the year so that I'll have enough to spend on vehicle maintenance in October for $250 and holiday shopping for $500 in December. You can add as many as you like, but just remember to add up your dollars as you go. You have to remember that the annual expenses fund is used for annual fees only. You can't take it out to pay for anything else that is not budgeted in the first place. This strategy can prevent you from taking out any credit card debt or a personal loan. And some common annual expenses are your annual gym membership fees, annual credit card fees, vehicle registration, car maintenance, tire replacements, birthdays, holidays, and anniversaries. And I also use it for car insurance premiums because I actually save more money by paying my car insurance every 6 months instead of every month. And not to mention the interest I earn every month for saving money in a high yield savings account. And mistake number 4 is taking money out of your 401k before your retirement age. And according to Bank of America, the number of people taking hardship withdrawals from their 401k was up 13% in the third quarter versus the second quarter of 2023. The number of workers who borrow from their 401k plans also increased quarter over quarter. It's a much better scenario than taking money out of the 401k, but it will still have a long lasting consequence for your 401k. And during one of the free consultations earlier this year, someone called me to ask if taking out a 401k to purchase a rental property was a good idea. The simple answer is no. And I know this sounds like common sense, but people choose to do it anyway. Taking money out of your 401k early comes with devastating consequences. For example, let's say you withdrew $50,000 from your 401k before your retirement age. The 10% early withdrawal penalty will cost you $5,000. And let's assume that your federal income marginal tax rate is 22%, and that's going to be another $11,000. And let's also assume that you have a state income tax that will cost you another 8% or $4,000. That is a total of $20,000 or 40% in penalties and taxes. So your net withdrawal is only $30,000 after everything. And a lot of people actually forgot to set the tax money aside. So by the time they file their taxes, they had to borrow more money to pay the federal income tax, state income tax, and the 10% penalty. Please do not do this. Take money out of your 401k needs to be your very last resort if you're in some sort of financial hardship. I would rather take out a personal loan for a 12% interest rate than take money out of my 401k early for 40%. I took out a 401k loan back in 2013 when I was spending out of control. And that was a horrible decision because it negatively made a huge impact on my retirement journey. And you can check out this video about the pros and cons of a 401k loan, and I'll link that video in the description below. And mistake number 5 is making excessive spending while you're in massive debt. According to a 2020 2023 survey from NerdWallet, 84% of Americans say they've sometimes exceeded their budget, and many of them used credit cards to cover whatever they overspend, which makes them carry a balance on their credit cards and incur an average of 24% interest rate. Is inflation to blame? Sure, but not entirely. If you watch Caleb Hammer's videos, let me know in the comment section down below if you do. You'll see that most people actually spend money on things they don't need. Not to mention that people who overspend choose to eat out at restaurants instead of making their own food. And I've been debt-free for years and I still cook at home. And if Caleb Hammer audited my finances back in 2013, he would tell me the same thing. I was on paycheck to paycheck cycle because I constantly went out to eat and never cooked anything. And I wasn't being responsible with my spending because I wanted to do things that felt good. So I eventually started living on borrowed money, and I maxed out one credit card and then moved on to another credit card. When I maxed out my second credit card, I moved on to my third credit card. So by the time I maxed out 5 credit cards, I had over $47,000 in total credit card debt. I had an average of 26% in interest rates between these 5 credit cards. Because I didn't spend less than I made, my debt repayments started to add up even more. Did I blame it on everybody else but myself? Sure I did. I blamed it on inflation back in 2013, how things got more expensive than in 2012. I remember saying thanks Obama a lot of times. And I blamed it on the government. I blamed it on everybody else but myself until I realized I was the one who made these financial decisions to spend more than I made. And if you look at the screenshot from 2013, this was all of the debts I had. Did inflation or somebody else make me rack up $47,000 in credit card debt? No. Did somebody else make me take out 2 car loans? No. Did the government make me take out a 401k loan? No. My personal accountability absolutely mattered more than anything else. And once I held myself accountable for these actions I took, I got myself on a debt-free journey and started paying down these debts. And I've been debt-free since 2016 with the exception of my mortgage. And I promised myself that I would never do such stupid things ever again. Remember, excessive spending can lead to debt, and debt can lead to reduced cash flow, and reduced cash flow could lead to a paycheck to paycheck cycle. And mistake number 6 is buying a brand new vehicle you can't afford and then justify buying it in the name of safety. Look, there are a lot of people in my comment section who justify taking out $800 or even $1,000 car payment because it was more reliable or safer. I used to think this way too. At one point, I had 2 car payments with a total of $800 a month. Did I need 2 vehicles? Of course not. What I didn't realize is that I kept rolling over negative equity from one vehicle to another every 3 years. So not only did my vehicle depreciate every year, but I was instantly in a bad loan to equity ratio because I put what I owed from my previous vehicle into the new car loan. Eventually, it just slowly built over time with tens of thousands of dollars in negative equity. My car payment only went up from there because these new vehicles depreciated as soon as I drove off the lot. And it's no secret, vehicle prices have continued to increase or trend up since the outbreak of the COVID-19 pandemic. The cheapest used car I found was around $12,000, which was a Toyota Corolla on CarMax in Carvana in the Las Vegas area with a little over 70,000 miles. But let me just use this as an example and show you what I would do if this is my first vehicle purchase or if I'm trying to pay down my other debts. I would have financed a vehicle, a used car, no longer than 3 years and less than 10% of my take-home monthly income. And there are other car buying rules like a 23A, which is putting a 20% down payment, a 3-year term, and no more than 8% of your gross monthly income. I like that approach too, but you need to make sure your car payments are no longer than 3 years. So that $12,000 car loan with a 20% down payment and a 9% interest rate will put me around $305 a month in car payments. If I can pay it off sooner, the better. And I know 9% is really high, but at the time I'm recording this video, we're still in a high interest rate economy. If the rates come down in the future years, your car payments will be even lower. Let's say I paid off my car by the end of the year 3. And what I did was I opened up a taxable brokerage account and invest the same car payment into an index fund. And this is not by any means specific investment advice to you, but this is the savings method that worked out for me. Because when I invest $300 a month to a taxable brokerage account for the next 10 years, with a 7% average annual return, I'm gonna have about $52,000 invested by the end of year 10. This is how I was able to afford the $52,000 vehicle I drive now. And I'm looking to switch a vehicle every 15 years. And that will give me about $94,000 in investments with a 7% annual return. And let me show you my website here. You can go to firesideshare.com/resources. If you scroll down, you're gonna see the compound interest calculator that you can use for absolutely free. The key here is to initially buy a used and cheap car that you can pay either in cash or paid off within 3 years. Don't worry about what other people think about your car. This is your future. And we're talking about here. If you want to buy a car sooner than 10 years after you've been driving that piece of crap vehicle for a while, you can always increase your contribution and buy a new car in 5 or 7 years instead. But let's say I want to invest $400, $4,800 a year with a 7% average annual return. That's gonna be about $28,000 in total value. Not bad. That's a 7% average annual return. And that's just by investing $400 a month. I got more out of the market in the past 10 years. It's about 12% average annual return. But the point of all this is make the money work for you and not the other way around. Take advantage of saving and investing your money to buy a vehicle. A vehicle is a depreciating asset. It is not an appreciating asset unless you own like a Lamborghini or Rolls Royce or something like that. Then that's a different story. Then I would probably say, yeah, maybe taking out a car loan makes sense. But because this is a depreciating asset, and if you purchase a vehicle every 3 years, your net worth is just not going to grow. It's just going to stay where it's at or even lower because that vehicle payment is going to hurt you in the long term. Mistake number 7 is not taking advantage of your employer match. If you watch my 401k video, there's a new rule that your employer can match your student loan repayment. If your monthly student loan payment is $200 a month, your employer could match the balance and contribute to your 401k. Just be sure to talk to your HR to see if they're offering that. The 2023 CNBC survey showed that 4 out of 10 workers still don't contribute to their 401k or employer sponsor plan. They're also missing out on any employer matches because they choose not to invest in a 401k. If you don't know if your employer does a match, it's time for you to talk to your HR to find out. Believe it or not, about 24% of Americans are not aware of the 401k employer match. And you have to treat your employer match as a part of your income that you won't see coming into your checking account. For example, when I worked in the private sector many years ago, I was making, I think it was about $150,000 in base salary. And the employer was contributing 4% of $150,000 to my 401k or $6,000 a year. That $6,000 a year into my 401k is basically a bonus I got from my employer. The only rule I had in order to get that $6,000 annual bonus to my 401k was to contribute at least 8% of my income to my 401k. So I was putting at a minimum of $12,000 into my 401k and another $6,000 from my employer, which is a total of $18,000. Now, I know that $150,000 salary is not what an average American makes, but even if you make $70,000 a year in salary, your employer contribution of 5% is already at $3,500. Do you know what $3,500 a year in your 401k will do for you? That's going to grow to $373,000 in 30 years, assuming that you always get $3,500 and not adjusted for inflation. So that one $3,500 employer contribution in 30 years is $28,400 with a 7% average annual return. Let me ask you this. Would you leave $28,000 on the table or would you leave $373,000 on the table? It's a no-brainer. And mistake number 8 is not taking advantage of the high yield savings account in a high interest economy. I probably have 7 or 8 high yield savings accounts between my business and my personal accounts. And there are banks that pay up to 5% APY right now. And there are about 70% of Americans who don't own one. Let me give you the simple math. If you had $1,000 in HYSA, that's $50 you earn every year in interest. If you had a traditional savings account that pays around 0.02% in interest every year, that's 20 cents you earn in interest every year. Which one is better? $50 or 20 cents? I'll let you make that decision. And this is how I diversified my cash reserve. In my checking account, I always keep at least 1 month of expenses carried over month over month. So if 1 month of my expenses is, let's say $3,000, then I keep $3,000 in my checking account. But keep in mind that I only do this after I have paid off all of my debt. But since I'm debt free, I like to keep that cushion in my checking account. Keeping that $3,000 balance to prevent you from getting hit with overdraft fees. You don't have to do $3,000, but you can do something like $1,000 or $1,500. It's completely up to you. And speaking of an emergency fund, we like to keep at least 6 months of our expenses and a rainy day fund in a high yield savings account. When you're just starting to build your emergency fund now, keep in mind that you should have a rainy day fund before an emergency fund. This account should only be used for something necessary and unexpected. The next savings account that we have is our annual expenses, which I talked about earlier in this video. And the next savings account we have is our discretionary fund. This is used for anything unnecessary, but but expected. What's considered unnecessary? That would be anything that is not essential or necessary. Something discretionary would be something like birthday presents, birthday parties, concerts, sporting events, anniversary celebrations, and Christmas presents. And most of these events I mentioned could cost you $200, $300 or more for a single event. How much do you think you'll spend on a hockey game? How much do you spend on your kid's birthday party? And how much do you think you'll spend on your Christmas shopping? Those are the things you're going to have to think about when it comes to the discretionary fund. And the next savings account we have, this is my favorite one, which is the travel fund. This is obviously for something that is not necessary, but more on the discretionary side. The reason why I separate this from the discretionary fund is because I tend to purchase plane tickets at least 3 to 6 months in advance. And there's more planning that goes into it when it comes to traveling. And the last high yield savings account that we have, this is more something one-time purchases. This is also called a major sinking fund. And you could be saving for a vehicle, home improvement, like upgrading your kitchen or down payment for your first home. My rule of thumb is if it's something I'm going to purchase within the next 36 months or 3 years, then I'm going to keep it in cash in a high yield savings account or maybe CDs. If it's something I'm going to purchase in 3 years or more, then I'm going to move that to a separate taxable brokerage account and invest in an index fund or something like that. Now, you need to assess your risk versus reward. You decide to put it in a high yield savings account or a taxable brokerage account. And mistake number 9 is not being intentional with your spending and savings. And I like that picture right there. I know this is a weird thing to hear, but there are people who just save everything and do not spend on anything at all. And there are also people I know who spend on everything and do not save for anything. My point is to be more intentional with your money every month when you budget. What is the purpose of saving your money? It is to spend it later. What is the purpose of saving for retirement? So that you can spend it later during your retirement. So let me be more specific. Intentional saving means that you're setting aside a certain portion of your income now so that you can spend it later on. That could be your home improvement within the next 3 years. If you save $50 every week, how much will you have in 3 years? It could also be the travel you've always wanted to do. If you save $100 every month, will you have enough to book a plane ticket to Germany next year to go to the Oktoberfest? I just went last year and it was great. If you save 15% of your income towards your retirement investments so that they can grow tax-free over the next 30 or 40 years, will that be enough supplemental income for you to retire with Social Security income, pension income, or maybe real estate income? These are the questions I want you to ask yourself when it comes to intentionally saving your money. Don't just blindly save money because it may not be enough or maybe even too much. And what about intentional spending? Saving is hard, but spending is easy. When I go out to buy something, I am automatically categorizing in my head if this is something I need or if it's something I want. That's pretty simple for most people to do, but some people choose to spend without thinking of any repercussions. If you purchase a laptop today, what are you going to get out of this laptop? How long is it going to last before you buy another one? I bought a Mac Studio M3 that's almost $4,000. How long is that going to last? It better last me for the next 10 years. If you like to go out to eat, how much do you spend on average? And should you limit how often you go out to eat? Do you ever feel guilty eating out after doing a big grocery shop? I do. I've done it before. And if you're looking to make more home improvement, is your project going to increase the value of your home? Or is it just going to improve your morale? Could you wait another year to do your home improvement when you have enough cash set aside to get it done? It's important for you to revisit these questions at least once a month so that you can detect your own pattern of spending. And I want you to reflect on the opportunity cost of your financial choices for what you're spending your money on. And are these purchases potentially going to bring you happiness, or is it a temporary fix to a much bigger problem? Are you saving too much money for your retirement but do not have enough cash set aside where you can access it immediately? When it comes to both spending and savings, you have to find that balance between the two. And you have to have financial goals that are achievable, measurable, and realistic. What I don't want you to do is save 50% of your income and you won't make any room in your budget to do something you want. This is a blind side that many aggressive savers actually have that they don't even realize. And mistake number 10 is sticking to outdated financial goals. Most people on New Year's Day will have some kind of New Year's resolutions that will involve their finances. Kudos to you if you're doing that. And I want you to write down every financial goal and start budgeting carefully so that you can achieve it. But I want you to take a moment to check in with your progress. Did you save enough for that travel you've always wanted to do? Did you max out your Roth IRA? Is the index fund you start investing at the beginning of the year working out for you? And sometimes you'll have to adjust your financial goals. Maybe some of the financial goals are no longer relevant to your needs. Maybe your 401k has an employer match you didn't realize you had. Maybe you're looking to switch jobs that will give you a pay raise and allow you to achieve your financial goals a lot sooner. I am not saying that you need to know where you're going to be in 30 years. What I want you to do is to start with just 1 year. What are you looking to do for the year 2024? Are you looking to eliminate your credit card debt by the end of the year? Are you looking to max out your emergency fund? Or are you looking to max out your 401k, Roth IRA, and HSA for the entire year? You can always download my free financial resources by visiting firesuch.com/resources. This is your time to take control of your finances today so that you can secure your future.